an abbreviated version. So what I'm going to talk about today is for newer investors, or maybe you're just getting started, or maybe you're looking to move it to the next level. But we're going to talk about some basic strategies and things that you need to consider and think about as you're building a real estate portfolio. I'm going to talk mostly about the tax implications. We've got our amazing speaker here that's going to talk about the legal implications. So let's move on. Let's see if this works. Yes. So I am a CPA. I have a master's degree in taxation from DU, also a certified tax coach and certified concierge accountant. Basically, it means I know a lot about taxes, and my specialization is real estate. My favorite investment is multifamily, multi-unit, because of the amazing leverage ability of having multiple units in one investment property. I like to focus in the areas of income producing assets, typically a business or real estate. And moving on, let's see how we do here, because I don't have my pointer with me today. All right, just my normal legal notice. I'm not an attorney. I'm not here to give you advice, but I am here to give you information so that you, as real estate investors, can make better decisions from a tax perspective. And so if we talk about the tax roll, we can talk about simplification. So a lot of investors, a lot of individuals just file their own taxes, but also you have the option, obviously, of hiring someone, or even hiring a preparer, or hiring an advisor. And ultimately the difference is, what are they doing for you? Are they just putting numbers on a tax return, or are they providing guidance? And is it an interactive experience where they're helping you develop your tax strategy for real estate? And that becomes important as you build a portfolio, because you're going to have a lot of different asset classes in that portfolio. Could be short-term rentals, could be long-term rentals, could be wholesaling, could be a lot of different types of investments that you have. And there is a strategy behind each one if you want to maximize the tax benefits of what you're doing. And so if we're talking about that, we're ultimately in the end talking about what types of asset class. So I'm going to focus a lot on real estate investment, so typically rental real estate, but also the basics. And so typically when we're talking about a real estate portfolio or owning real estate, we're talking about some kind of, ultimately in the end, some kind of a business entity. And so typically what you're doing is you want to have some kind of liability protection. And typically with entities, we're not talking so much about the tax structure, but as of the legal implications of the protections in place. So typically we're talking about some kind of limited liability. And you can do that in a multitude of ways. And the point behind liability protection is you want to protect your assets, personal and business. An entity structure, when you're owning real estate, is a viable option for you to help mitigate some of that liability. Typically, your entity doesn't exist unless you're filing or registering your entity at the state level. And then once you have an entity registered, you're getting an EIN for that business, you're opening your business bank account. When we're talking about collecting rental income and paying expenses, we're typically talking about bifurcating those income and expenses from personal or other business accounts to specifically one related to that entity. So you want to be collecting rents and paying expenses out of a separate account and not necessarily commingling your funds for your rental activities, your investment activities in the same account. You'd lose some liability protection when you do that. So ultimately, I have choice of entity here, but there are pretty much typical entity structure that you keep and hold your investments in, and entity structures that are very rare that you will use to hold or keep your real estate in. You may have heard the term LLC or partnership. You will see that most of the time that is how real estate is owned. You typically don't see it in a corporate structure, and that is due to the way that it's treated, especially in terms of if you need to refinance or change title. It has less than ideal tax consequences. But you can own real estate as a sole proprietor, which ultimately in the end means I have no entity structure at all. It's just me, myself, and I. There's where you have the most liability. You can add some kind of protection by adding an entity structure. This is important from a tax perspective because this is going to help identify how you report your real estate. So if I'm a single member LLC, I don't have a separate tax filing. It's just an additional form on my individual tax return. But if I add owners of my entity, I'm now a partnership. So now I have this whole separate tax return filing, and what we have something called flow-through income, which is the K1, and essentially the net of all the activity in that partnership flows through to my individual return, and all the tax consequences happen on that individual return. And by doing that, you do limit some more liability, but you also now have more complex filings, and you have additional tax returns than just a 1040 filing. The LLC itself, even the partnership, does not change how rental or investment income is taxed. It just changes how it's reported. So if we're going to talk about what kinds of expenses you as an investor are looking at tracking for purposes of managing the activities from your investment activities, we're talking about section 162 of the tax code, ordinary and necessary. We're talking about what expenses are common and accepted and helpful and appropriate. And so think about real estate activities, and especially if you're investing in real estate, you have short-term rentals, long-term rentals, you need to be able to categorize and track those expenses, and obviously rental income as well. And you're typically reporting activities. So instead of me having an entity that has multiple properties, I'm required by IRS rules to individually list my activities. And so I do need to be tracking rental income and expenses by property, not by entity. So if an entity owns multiple properties, I should be separately stating those activities. Now, when it comes to examples of what is this, examples of ordinary and necessary expenses you may have as a real estate investor could be advertising, could be repairs and maintenance. I don't know why I did this, but it's doing that. But contract labor, so maybe you're hiring contractors to come and do some work on your property. So you may have some expenses related to what you've paid them for them providing the services that they're providing. You may hire an attorney that's going to help you set up your entity structure or set up the protections that you have in place from a legal perspective, or a professional could be a CPA or an accountant who may be helping you set up the bookkeeping process, or helping you gather and set up your entity, helping you prepare and file tax returns, et cetera, et cetera. So you can have legal and professional fees on top of that. And most people don't think about this, but telephone and internet can be a deduction. May not be 100% unless you've set up an entirely separate account, but if I'm using my phone to contact potential tenants, to set up showings, to do the activities necessary to find and manage my properties, I should be able to write off some of those expenses, like your telephone and your internet. And so things like these kinds of expenses may not be as obvious, but it helps you be able to manage your properties, your investments. It should be a write-off. And I have a couple more here. Insurance, obvious related expense, real estate taxes, mortgage interest. You may be buying supplies, for example. Let's say it's a short-term rental, and you provide some toiletries, tissues, linens, towels, and things of that nature. Those are supplies. They should be a write-off.
So interest on, so if you use like a HELOC on your regular property as a down payment on investment property, that interest, as long as the interest is for debt related to buying that rental property, that interest can be written off, correct?
True. So the IRS has something called tracing rules. And so if I'm using a source of funds to purchase a property, we'll call that debt. The IRS wants me to trace what I use those funds for, because if it's not used for a qualified purpose, I can't deduct it. Just because I use a HELOC or a line of credit doesn't mean I automatically get to write off that interest. I should be tracing where I use those funds, allocating the interest on those funds to that activity, and then I'm able to deduct that. So if I took out a HELOC, paid off my credit cards, yes, it's a HELOC and you may get a 1098 at the end of the year, but that doesn't automatically make it a deductible expense. The IRS requires that you trace what you actually use those funds for. So yes, Something to keep in
Or
mind
you
is
do
you
a
may,
cash out refinance on your primary residence, it's not a rental property, use it to buy a rental property, that debt's tight, as long as you can trace it.
you have to trace it, yeah.
Yep.
Some kind of documentation, yes.
Your previous slide, you don't have to go to it, but the LLC.
Yeah.
You can file your LLC as an SC or partnership. The LLC is just an entity. The way you file it is the last 3 rows. I've always been confused about that. What is the difference between LLC and, because you file it most of the time as an S corp, correct?
I know we're gonna get into that in more detail. Is it okay if I answer or you want me to wait for that?
It's up to you.
Okay.
I'm gonna hit on LLC.
He's gonna hit on that, but here's
Okay.
what you need to know, is entity structure is state specific. State law dictates your structure. And so LLC, LP, C Corp, those are state level entities. S Corp doesn't exist at the state level. So you have to register some kind of an entity and at the federal level, make an election to be an S Corp. Or you can choose any entity level at the state level and elect to be taxed differently at the federal level.
The 3 elections at the federal level is partnership, S corp, and C corp typically. I know there might be more, but those are the most common.
True. Now, if I registered as a LLC, like a single member or multi-member, I don't have to then make an election to be taxed as a partnership, it's automatic. But if I registered as an LLC, even a C corporation, that's how I'm gonna be taxed unless I make an election to be taxed differently. To point out, if I have investment real estate, like rental real estate, I'm typically never gonna make an S election on that entity. Typically. Now, if I'm doing other types of activities, like flipping, for example, it may make sense for that entity to be an S corp. We're not gonna get into that in this class, that's not really what we're here to focus on for today. Cause we're gonna open up a whole can of worms that could take hours, and I just love to talk about tax, so I'll just go on and on. Over my time, you can ask them how I like to do that. So I'm gonna try and keep this within
I
like
love
20
tax
minutes, so
too,
we'll see
so.
how that goes. But yeah, so you can change how your entity is taxed. You are more than likely not going to do that as an investor unless you have specific types of assets that you hold, because an LLC isn't going to be the best tax structure for every type of investment. It's really a legal structure for liability protection. Again, the tax consequence in that instance changes at the federal level, but in our case here today, probably not something that we're gonna necessarily utilize because it's not always gonna be in our best interest. So,
But a high level, cause I know there's the structure for the legal liability, but for the for taxes, picking a structure doesn't change your taxable liability, right? You're gonna have the same tax liability overall
well,
in general, or is there some?
It depends.
Depends.
Yeah, because the C corp has that famous double tax.
double taxation, but C Corp is a flat tax rate of 21%. LLC is just, treated as self-employment income, except real estate has a special exception. It's not considered to be earned income for purposes of self-employment tax. But it's typically subject to SE tax, self-employment tax. S Corp allows you the ability to have a structure like an LLC as an example, but elect to be taxed differently. And in essence, once I make an S election, I'm not considered to be self-employed anymore. Therefore, self-employment income in an S Corp is not subject to self-employment tax. So we're getting a little complex.
You're paying yourself a salary, you're not
If you are,
an
potentially.
S corp. Okay.
Definitely,
So it really depends.
it depends.
So you need to make a decision from a legal liability standpoint, and you need to make a decision from a tax.
Exactly.
And they don't have to be the same.
And they may not be the same answer, but
So you
that's
go
why
to
you
these
consult with an
people.
attorney.
Yeah.
People will say, how should I structure my business? And that's really not my place to tell you. Consult with an attorney who listens to what your intentions are, because they can guide you as to the best structure for you.
And you can guide on the best
And
tax
I
structure.
guide on the best tax, and it could be that we conflict, and that's okay.
I didn't realize you could do separate for tax versus.
But just for because you got my juices flowing, last question I have on this subject, because I don't want to take it up. But for a long-term rental, how do you file it from a tax perspective federally, typically? I know it's different, but most people in this state.
Schedule E, page 1. Depending on my ownership, Schedule E, page 2, if it's a flow-through, typically how you would record it. I know some people talk about short-term rentals and think it goes on Schedule C, but in rare cases, does it actually go on Schedule C? You have to be offering or providing substantial services. Almost all rental real estate goes on Schedule E.
Okay.
And short-term rentals have a 39-year life and not a 27 and a half, even if it's residential. It's treated like commercial
It's
when
treated like
the
commercial.
occupancy is expected to be 30 days or less. And then there's a special loophole, 7 days or less, that we're not gonna get into too much because we're getting into the weeds, but there are some specific rules that if you do things a certain way in a certain order, you maximize your tax benefits. And then there's obviously some other ways you can do it that may not be ideal, but maybe in your situation it warrants it. Like a C Corp, for example. But it's just rare that we see that because it's just not beneficial for most investors. So finishing up our list here, ordinary and necessary, you may have supplies, you may have other operating expenses that come up during the process, like printing brochures, for example. I should be able to deduct this if I'm printing these brochures, handing them out as part of my advertising expense or printing and reproduction. So another expense that I want you to think about as a real estate investor is the use of your automobile. Because if I'm driving around, looking at properties, running to the store real quick, meeting a potential tenant for a showing, I should be able to write off that expense. Now, it may or may not be a business expense based on how you use that vehicle, but you could certainly be deducting mileage for the business use of a personal vehicle. For 2024, you're writing off 67 cents per mile, and so you are keeping some kind of a log to track business and personal mileage so that you can document what you actually drove for business and maybe take a deduction.
Is it either or? Can you do this or deduct the gas?
Right, it's one or the other, it is not both.
Which is more beneficial nowadays?
Well,
Gas or
it
mileage?
depends on how much you drive your vehicle, but if it's a business vehicle and you drive it more than 50% for business, usually the actual method is better. But if I don't drive it that much, then it may not be beneficial. I mean, year one of somebody buying a new vehicle or leasing, we run scenarios where we're looking at, well, what does it look like if you were to drive it and just reimburse yourself? What does it look like if you bought X, dollar amount basis in a vehicle and depreciate it and then estimate what the gas is and the insurance and percentage wise? And then am I buying a heavy enough vehicle? Because then there's more benefits from write-off than if I buy just a regular typical passenger vehicle. I still get some nice write-offs, but maybe not as much as if I bought a heavier vehicle. So we can get into the weeds again about some of these, but understand that your automobile is also going to be a deduction. The question is it a business asset, personal asset, and what's going to be better for you? Now, if you're not driving it more than 50% of the time for business, in my opinion, it may not be best to take the actual method. And technically, when it's driven less than 50% of the time, you can't accelerate depreciation anyway. And so there's a reason when you might use the actual method and a reason why you might take the standard method. And with liability on an automobile, it doesn't go away if it's a business asset or not, probably increases. And so you have to think and take that into consideration. So for you as a new investor, you probably don't have a vehicle that you drive for your business. So reimburse yourself for the business use of your personal vehicle. It's an allowable deduction, just like your telephone and internet. May not be in my business name, but I sure am using it for business purposes. May not be 100%, but I am using it. So maybe I should take something as a deduction. It's an allowable expense. One more?
What if an investor in a different state, can you deduct the travel,
That depends. So if I have an entity set up and I've got my rental income coming through and my expenses coming out, I don't know why I would have a travel expense unless it was specifically related to that property. But maybe I have a different business that I run that may have an expense where I need to go travel for some purpose. So if my trip is business in purpose, typically it would be a deductible expense. So I'm doing my due diligence, asking questions, making sure I understand and feel comfortable it's an allowable expense, because I have penalties if I'm signing this return and there are these mistakes or errors, we'll call them errors. And so, based on the size of it, I could have a penalty for not, doing enough homework to determine that was not a reasonable basis to deduct that expense. But that's a great question. So thank you very much for that. So, let's go on. Because what if I work from home for my real estate, there's this space that I use to conduct business. Can I take something from my home for the fact that I use space to help me run my real estate investment business portfolio? Short answer is yes, it depends. And so I have to have exclusive use of that space. So if I have a bedroom that has my computer, that's where I go to work, there's a bed in a corner, is that exclusive use?
No,
Why not?
because you have a bed.
Because there's a bed. Even though nobody uses it, it's there, the IRS has already said, that's not exclusive use. You take the bed out and
Yes.
it's a home office, assuming you're using it exclusively for your real estate.
How does the IRS figure this out, by the way? Like, how would they know?
I mean,
You
they
can
ask
just
a lot of
move the bed out
questions,
of
and if
there.
they feel uncomfortable with your answers, yes, they could make a site visit, or they could just flat out deny your deduction.
Hmm.
We're not talking huge numbers with the home office, but it's a deductible expense if you qualify. And
What
these are
about a
typically
dog
the
bed?
rules. Sorry?
What about a dog bed?
Nope.
You know what? I don't have any control over my dogs entering and exiting. I mean, I can shut the door, yes, but then they're scratching, and you know what? I don't want them to damage it. I have no control over that. I still think that's exclusive use. I don't think the dogs count. Now,
I work
kids,
better with my dog bed.
kids coming in and doing homework, I think does not meet exclusive use. Or your spouse coming in and using the office from time to time. I don't think that meets exclusive use. Dogs, on the other hand, you know, I got Chihuahuas. I can't tell them no. For one thing, they're my babies, but two, they're Chihuahuas. They don't take no for an answer. So, yeah, I'm just having a little bit of fun with you, but you see kind of the other things that you can be thinking about. If I have a W-2 job and I do real estate on the side, and I typically work from home, do you think that's exclusive use of that space? No, because W-2 is not the same thing as real estate portfolio. So real estate business is different. Exclusive use means I have to use that space exclusively for managing my real estate portfolio, which means if I have a W-2 position, I can't come and use that space when I'm not working on my real estate.
If you're married though, and your spouse exclusively uses that for real estate, and you exclusively use something for a W-2, can you write off
If you have
both?
two separate spaces, sure, because that one space meets the exclusive use test. Spouse's space that's W-2, no. And unreimbursed employee expenses went away in 2018 with the Tax Cuts and Jobs Act, and so, no. If I'm a W-2 and I have all these additional expenses, I can't deduct them anymore. But I have a real estate business, and I don't use that space for anything else but managing my real estate portfolio, I can take a portion of all of my home expenses. Mortgage, interest, if I own, taxes, insurance, rent, if I rent, maybe utilities, you know, maybe I pay some kind of an HOA or something like that. Those expenses will typically become deductible, and as I mentioned before, it's a relatively small amount. We're not talking big numbers. And not everyone likes to take home office, even though they could, or maybe they qualify, because it's a little bit of a red flag. Because not everyone realizes what it means for home office in the exclusive use test. Typically, you're gonna see a home office be 5, 10, 20% of a home. 20%'s high. 10% to 6%, pretty average. Now, if I have 1,000 square foot studio and my home office is in a corner, it could be, 100, 200 square feet. It could be 20+%. But the higher the percentage, the more of a red flag, because that's so uncommon.
So you know what is it, there's a new way that you don't have to.
Simplified method.
Simplified method, is that
Five-
less of a red flag?
No, not necessarily. I mean, it's $5 a square foot up to a certain amount, so I'm maxing out how much I can claim, but it simplifies it. It doesn't remove the fact that it still has to be exclusive. It just means I don't have to collect all these expenses and then calculate my portion. It just takes a simplified approach.
Okay.
I still have to have exclusive use. I don't get
I
out
just
of that.
didn't know if it
Yeah.
put it less
What
of a
does
red flag.
inventory exception mean?
Well, I think about that more for real estate agents as an example, but an investor would be the same way. So if I have to go, let's say I have signage and flyers and things that I've printed up, and I run out of room, I don't have enough storage, but I use a closet in a different room.
Mhm.
So inventory typically is if I use a different space because I need the room and I store something there for use in my business, typically that's what that means. Is that I could have additional square footage that I'm using for the purposes of home office because I'm using exclusively some other space to hold some of
Oh,
the,
and you can use that? even if
Items.
it's separate?
people like to use their garage, but the problem with the garage is it might not be exclusive use. Especially if you park your car in there. Doesn't
My
matter
coat
that you put your
closet
stuff on
is
the,
now exclusive use of my real estate.
Yeah. but just because I have, certain things in boxes, in the shelving in the garage doesn't make it exclusive use if I park in there. Exclusive use means no other purpose.
Yeah.
So you're not using it for some other purpose. So getting towards the end here, and hopefully I'm still okay on time. So there's something called qualified business income, or QBI, that income produced in certain industries can qualify for an additional up to 20% deduction or reduction of your taxable income. Has to have income. Real estate income can qualify for this. So after all expenses, including depreciation, I do this calculation and I end up with a little bit of a deduction. I'm allowed to reduce taxable income by another amount that I wasn't even out of pocket. That's what qualified business income is. Key word is after all expenses, including depreciation. I'll talk about that in a minute, what depreciation is and why you need to claim it. But this other deduction that you don't have to do anything for, you're not in a profession where you're gonna run into an issue where you're limited in this deduction, or that deduction, becomes zero because you have a certain type of industry like a professional, where we're in professional services, we actually get phased out of QBI if our income is too high. So actually, probably the only other way that you're gonna lose out on this deduction is if your income is too high. Eventually QBI does phase out. But for somebody in a specified service, like a professional, like a CPA, even an attorney, if our income is too high, we lose out on this additional deduction. So there's a real investment in strategy for how can I reduce my income as much as possible, because this 20% deduction on all of my business and real estate income sources could be on the line.
So this works for someone who's a W-2 and just invests on the side?
Not a W-2, because that income does not count, but if they have a business or if they have real estate income after all expenses, that income qualifies for calculation.
And they don't have to include their W-2 income?
W-2 doesn't count.
Okay.
W-2 is used to count what the cap is and what the phase out is, et cetera, but it's not part of the calculation for how much I can deduct as QBI.
But most of the time with real estate, there's so much deductions already that you typically get that this is minimal.
Yeah, but you have to be careful, because I just can't claim no QBI, or my investment doesn't qualify for QBI just because I end up in a loss situation. Because I can't claim it when I have income and oops, I have a loss. No QBI. This investment doesn't qualify for QBI. You're typically not jumping back and forth and taking advantage when you have income and then not taking it when you have a loss. You end up with QBI and you have a loss. That loss of QBI carries over, and it potentially disallows or reduces QBI in the future. Now this is profit motive. QBI comes from profit motive. So you could make an argument that I'm in a loss position because I didn't intend to make a profit because I maximized all my deductions. That's a pretty strong argument though. QBI qualifies for real estate, or actually say real estate qualifies for QBI. Even if you're in a loss situation, that loss is calculated with the QBI, and that negative QBI carries forward and offsets a future year's positive QBI, technically.
This may go away, right? Because this was just part of the last.
Could be,
Okay.
could be, but it kind of
Well, let's
equalizes C corporations and everything else, and so, we hope it sticks around because I want some free money. We're not talking,
I like too, but.
yeah, I mean, now if I'm a really high income earner, but not to the point where I get phased out, it's a nice reduction of my taxable income. So I'd love it to stick around.
Yeah.
Now, documentation wise, I'm a real estate investor, what should I be doing? Obviously, you should be tracking rental income and expenses, or the income coming in for your investment and the related expenses per activity. Sometimes per door, or sometimes a duplex can be treated as one or two. It just depends. But I need to be doing some kind of bookkeeping, keeping track of my income and expenses. Now, some people will use a spreadsheet, and that's okay to an extent. Some people will use something like QuickBooks, Xero, or some of these online apps that you can use, software, that help you track your income and expenses. Now, if you have a simple structure, you maybe don't need some of those softwares. But if you're a partnership, corporation, S-Corp, etc., it's probably, and especially if you have a big portfolio, it's probably ideal to use a software, because you need the ability of accurately and cleanly allocating income and expenses to each property. And there's multiple ways of doing it, but software facilitates that process for you. Number one, you're not missing expenses because you didn't know they existed because you forgot to add it, or there's an adding error, or your formula wasn't adding correctly. But also for reconciliation and documentation purposes, you want to have a strong performance for an audit, show them a QuickBooks that shows all the individual transactions and categorized. It's kind of hard to argue that your expense is unreasonable when you can see what the expenses are, and they're all deductible expenses. But if I have a spreadsheet, I'm like, yeah, this was a $10,000 deduction. Here, let me find those receipts so I can show you. And then I'm like, okay, going through my records, where are the receipts? Where's my credit card statements? You know, you don't necessarily have that. QuickBooks and Xero and some of these softwares give you the convenience and the cleanliness to help support you should you be audited.
When
So-
you send your taxes though, you don't have to send each individual,
No,
you just show them the total
show
deduction.
the total of the category.
Unless they audit you, then
Unless
you
they
show
audit
it.
or examine you and ask for some information,
Yeah,
exactly.
you trail down all of them. to
But
the receipt.
They're not gonna come tomorrow and ask you that, they're gonna come 3 years from now and you're gonna be like, well crap, I gotta go back 3 years, find the box of receipts and I don't even know where that is, and then the statements, I didn't print them, I'm just gonna go online and download them, oh wait, they're not available anymore, how am I gonna document my expenses? If they don't, I mean, it would be so nice if they came tomorrow, cause I'm like, it's fresh in my mind, I can answer your questions. 3 years from now, I'm like, I don't know. I mean, I've done that,
You
I've
just
represented
take your
clients and
files.
audit.
I've got everything like down to the receipt level for mine, if they do come, but of course, can you just be like, here you go, you find it, or do you actually have to go and find it? for me?
Yeah, I strongly recommend you don't do that, and a lot of accountants, including us, don't do that anymore, where we don't take the receipts and categorize it. It's not efficient and it becomes expensive. And so ideally, the software that you use, like QuickBooks is an example, where the bank downloads directly into QuickBooks, it's smart enough that it starts to remember what similar or like kind transactions are, and it starts categorizing it for you. So every time Verizon comes in, it knows it's telephone expense. Isn't that convenient? Isn't
So
that
just
convenient?
because it links to the bank accounts, they trust that more than a receipt on the IRS, is that what you're saying, or?
Well, I mean, they have primary evidence, they have secondary evidence, and a bank statement, a credit card statement is secondary evidence. Of course, they like the receipts, but maybe you don't have it. Now, if they were asking for this $10 Starbucks receipt, be like, they're not gonna ask that, it's $10. $10,000 expense that you've deducted, they may say, well, I see it's on your credit card statement, but show me the receipt. Like, there may not be enough information on the line item for them to feel comfortable. And auditors, and especially the new auditors for the IRS, they're just not as familiar with some of the rules. And so we're having to fight a little bit more for clients because the IRS agent, they don't make the effort. Oh, that's not deductible, that's not deductible. Yes, it is deductible. And here's precedent, and we have to go back and show them tax court cases or rules and regulations to show them where it's deductible. And they're really getting good now about picking up audits on short-term rentals because they don't believe you should be able to offset earned income with the short-term rental loophole. And so now they're increasing audits and saying, no, you can't do that. And it's literally written in the regulations, the Treasury regulations, that you can. And we have to physically show them that this is where it says, this is exact scenario, you can take this loss when you materially participate and offset other income sources like earned income. You typically can't do that otherwise. There's specific rules about, okay, I have a loss in my rental activity, I typically have to qualify to deduct that loss, and there's specific rules. It's the most audited area of the tax code, but it's also the most lucrative if you do it the right way.
If it's like seems complicated and you hire like someone who will manage it for you,
Yeah.
is that deductible
Sure.
like fee for the
Legal and
person?
professional fees. I have a bookkeeper that does my bookkeeping. I pay her $100 a month, whatever, to do my bookkeeping. That expense is deductible.
And if you hire a property manager, they usually have good tools for most of your expenses already, so they'll give you financials that you can use too.
Yeah, I have a lot of clients that use Colliers, especially when the bigger investments, commercial real estate, etc. And they do internal bookkeeping, and it has to be accurate. And we get the bookkeeping from them. Now, they may do 100% of the bookkeeping, they may do 80% of the bookkeeping. Because if the client has more than one bank account, Colliers is only doing the bookkeeping for what they're responsible for, not everything else you do.
At the high level, to simplify it, just anything that you spend on your rental, you need to keep in track.
Yeah.
And then have
If
your
you're spending money
CPA
to
tell
make
you
money, you should be
whether-
able to write it off, ultimately.
Yeah, if the intent is for
Business
helping your
purposes, yeah.
business.
I used to have LLC as corporation for different type of business.
Yeah, so same thing.
But
Like,
I was
as long as
scanning
you're
the
using
receipt
it.
and just like saving them like for years, so I still
So
keep
I'm
in the box.
A little over on my time,
Okay.
cause like, but, last lastly, we're talking about statute of limitations. You know, there's a time frame in which you should keep your receipts. Depreciation, which
What is it,
ultimately,
7 years?
sorry,
What's statute of limitations?
typically the statute of limitations is 3 years.
3 years, okay.
However, if it's a material misstatement, they can open it up for 6 years. If it's criminal, there's no statute. We typically recommend you keep your receipts and documentation 7 years. But, you know, in the day and age of scanning and saving it to a PDF, I mean, you can save it indefinitely versus a Home Depot receipt that after 6 months or a year suddenly vanishes and you've got this blank receipt that you don't know what you kept because it literally
Vanished.
faded. There's
Right.
no more ink on it. Like, that's not helpful. Anyway,
I
last
just
piece is
scan it.
depreciation.
I just-
Because assets depreciate over time, they lose value, and the IRS has specific rules for you writing that off. What I wanna emphasize here with real estate is the IRS doesn't necessarily care if you take it or not, but when you sell it, they're definitely adding it back as depreciation recapture. So ideally, you want to take depreciation on your properties. It benefits you and it harms you when you sell and it's added back as depreciation recapture, whether or not you actually took it. So there's some importance to it. Understanding that depreciation depreciates over time, it slowly loses its value. Land gets carved out because land does not depreciate, so you're not depreciating potentially the full purchase, except in some instances. You break out land and you do depreciation on the remainder, or something called a cost segregation that can help you break down your purchase even further. The goal is how fast can I write off these expenses? You know, I mentioned before, 39-year life, 27.5-year life, that's a long time to write something off. So if I can speed up that process to a 5-year, 7-year, 10-year, 15-year, etc., I can create bigger deductions now that offset my income, if I can qualify to take them. That's ideal, yes.
I just have a question about depreciation and the cost seg. Ideally, if you wanted to buy a house and remodel it, the best way to get the depreciation would be to have it open for business, depreciate it with a cost seg, wait a calendar year, and then remodel, so you get both deductions for the remodeling and the
Well,
cost
remodeling is still broken down between deductible expense and capitalized expense. And one of my slides actually had capitalized expense, I just didn't really talk about it. But repairs and maintenance is still the deduction, but if it meets the definition of a capitalizable expense, I have to capitalize it. I don't get to write it off immediately.
But
So
you would
if-
get both credits.
I would say cost segregation is, ideally, you're doing it after your home, after the property's been improved. You get the biggest bang for your buck in that. Because a cost segregation isn't typically somebody who's an outside third party who has specialization in the area of valuing individual components, an engineer, who goes in and says that's, 5-year life, 7-year life, 39-year life, 15-year life for land improvements, and they break it down. If you go out and spend a bunch of money on improvements, there's no breakdown between what your contractor may have done. Unless you do
But
a
then
cost
you
seg.
would
You
lose-
can't individually decide what that breakdown is. It's not gonna hold up in an audit. An
You
engineer's
could
report
lose
could.
what you had. Let's say you had a kitchen that was ugly, you hated it, and then you did the remodel and then cost segged it. You would lose the potential depreciation of the old kitchen if you do it that way.
Not necessarily.
Because if you rip it out and put a new kitchen in, and then you do a cost seg, you can cost seg the new stuff, but you cannot cost seg the old stuff.
I think I understand what you're saying. I'm not sure I agree with that though, because typically if I'm remodeling, I'm already increasing the value. So the engineers comes in and says, you have Formica, I'm gonna give you $1,000 for your countertop. Oh, look, after remodeling, your countertop is now marble, I'm gonna give you $10,000. There is a difference in the valuation that an engineer uses, and so I don't know if I'm comfortable with that argument, because if I do some really nice finishes, I'm gonna increase the value. That engineer takes that into consideration in valuing the asset for that asset class. I think you have more potential to have a higher deduction if you wait until after your repairs and maintenance, your remodel, than doing, doing the cost segregation, then doing a remodel. Because all you're doing after the remodel is removing out of service what you did for cost segregation,
Right.
and then capitalizing or expensing the remodel. I don't think you're getting the best benefit. I think you get a better benefit if you do the cost segregation after all the work is done. But if somebody else has experience and they've got a different opinion, I'd love to hear it.
I had an experience like that, and it's interesting you say that, because I don't know what the true answer is. My CPA had told me to cost seg first, wait the calendar year, and then do the improvements, because although you get it all up front for the cost seg, and then when you remodel, it would be, 10, 15 years, you'd use up all of your deductions up front if you did it after the remodel versus.
I guess my concern would be depreciation recapture on the items in your cost seg, and I don't wanna take any more time on this, cause I'm taking your time away from presenting. But, if we wanna talk
Talk
maybe
after.
offline, or, after, we can
it's
talk more about that.
Sorry.
Some people don't even like to talk about depreciation at all.
Some people don't take depreciation because they don't know what it means and the tax implications. So I hope that was helpful. If you have questions, I would love an opportunity to chat more with you, answer questions, provide feedback and more clarity if something wasn't as clear. And I appreciate the opportunity to come and speak with you tonight.
Yeah, thank you.
Thank you.
Very good, alright,
My turn.
your turn.
That's a tough act to follow.
Great lecture. Sorry to
Do we want to
interrupt
take a
so
quick
much.
break?
It's always.
No, I'll cut it, I do cut, I
We've got
edit it
good
later,
questions.
so.
Yeah, that's not accurate.
All right.
I didn't say I
guys.
didn't know that one.
It's quarter after 7.
Where do we want to start? I'm Grant Vendria, I'm a lawyer.
Well, what do you guys wanna know legal wise, cause there's a lot.
Yeah, so I'm not gonna do legal advice, just like we had in the previous presentation. I can give information for educational purposes only.
Do you know of the new laws that may be coming down the pipelines for real estate related?
The
Does
only-
it scare you?
No, I'm not bothered at all by the recent legislation,
The
you know,
2
it's-
months ago, the what is it,
1029.
yeah.
I just had a client that got impacted by that, today. And the call was, for an eviction, and they said, the tenant violated the lease because they have people in the house that aren't listed on the lease, and we gotta kick them out. You can't do that anymore. Well, you really couldn't ever have done it. It's always been a civil rights violations to discriminate against somebody based on their family status. So if they have 6 kids, or grandma lives with them, or they have a non-blood related domestic relationship, you couldn't kick them out because of that. And now we've just codified it.
Even if they're not on the lease?
Even if they're not on the lease, it's none of your business. You can't discriminate based on their family status. So if they're claiming to be family or in a domestic relationship, you have no business prying. You can get in some criminal hazards if you go down that road too much. The new law, in a lot of the annotations, they actually talk about referring these civil rights violations for criminal prosecution, and the tenants getting the benefit of any fines that get assessed. So the tenants get incentivized to report activity that violates their civil rights. So the only thing I would say with the new law is you just can't discriminate based on how many people are in the property. And just stay away from that.
So I'm specifically talking about the auto lease renewal, so you can't now, just
You can't kick them out just because the lease terminated.
terminates, yeah, so even if you
unless-
have a 30-day month, during the
Now it's
30 days,
90
month to
days.
month, it's 90 days.
Can you
right?
increase the rent to the amount that you like, or is there a law that prevents you from increasing it to a certain amount?
There's limitations on how much you can increase the rent.
What are
I think
those?
it's 10%. I think it's a max 10% per year increase to the rent amount. So, and that could
There's
change.
a 90-day notification if at the end of your 1-year lease, you have to give them,
So the idea is if you're going to terminate because for no other reason than it was the end of the lease, you have to give them 90 days advance notice.
okay,
So if they fulfilled the lease and then you give them notice, you have to, it's like a year and 90 days, a year and 3 months.
okay.
But the idea is you can hit them at 9 months into
And
their
then
lease and tell them,
We're gonna.
Like, I have clients that are like, I wanna sell my rental, they come to me, I'm
Yeah.
ready to sell my rental, and they say I have it's not a problem because the tenants are month to month, and I'm like, no, it is, because you have to give them 90 days notice
even with the.
before they,
Right.
before you can sell it.
And there's all kinds of maneuvers, legal maneuvers that you can put in your lease. You know, a lot of clients that come in, I had one yesterday, wanted to get rid of his husband and was saying, do I need to do an eviction? No. If the husband's not paying rent, change the locks. It's a domestic relationship. That's not a sheriff's eviction. That's not an unlawful, forceful eviction. So if it's a, you know, this comes up a lot with college share agreements. Depending on how that relationship developed and whether they're paying rent, sometimes you do have the right to just change the locks. And so I see this with subtenants all the time. If the landlord has no knowledge of what that relationship is, things can get a little wonky. So when you have a troublesome tenant, you know, you just have to have that conversation with your lawyer and figure out what you can and can't do.
Yeah, I was gonna say, I mean, there's no law about, if they get mail there or like they live there and they've been getting mail there and they've been there a certain amount of time.
Colorado has an implied right to residency after 3 days.
Wow, 3 days?
3 days. So it's a shifting of the presumption. The presumption starts to make it look like they have a right to residency, and the magic words are, I pay rent. So like a lot of the squatters that are being reported, law enforcement says, we don't have any squatters, there's no squatters. That's not true. For law enforcement to get the squatter call, they have to deem that the person is a trespasser. And what happens is law enforcement arrives on site. Let's say you've got acreage and there's an RV that pulls up and parks. The person says, I'm providing security services as rent. Keyword rent. Now it's an eviction, it's not squatter. If they had admitted, yeah, I trespassed and I parked here illegally, well then they're gonna go to jail for squatting, right? And we have a new law on the books, it's a squatter's eviction. We've gotten a couple of those through. They're really rapid, so it's like less than 4 days from beginning to end to have the eviction done. But they're also really rare. The judges don't have any idea how they procedurally function. So when we get to court on squatter evictions, we have to literally coach the court on what the new laws say.
I have a question. If you're having let's say a long-term rental, and it's a two-part question. What is the, like you can say up to $200 expense the tenant has to cover. What is that amount legally? And the second question is, if they ask you to repair something, let's say the toilet breaks, as a landlord, how long do you have to repair it before they can say you're in the wrong at some point?
A reasonable amount of time, usually 10 days.
And then what's the amount that you can put in a contract that says up to this amount, the tenant is liable, past this, the landlord is
A
liable?
reasonable amount for non-normal wear and tear damages. So if the tenant caused the damage, so like I've got a situation right now where there's a sump underneath the toilet that's in like an elevator. You flush and it goes into a sump, and then there's a pump in there and it ejects it from the house. This is an old house in downtown Denver. The tenants were notified in the lease not to put anything else down there but septic safe toilet paper. Well, they flushed rags and cigarette butts. They're responsible for the whole thing. That's not maintenance. So whatever that cost is to repair that pump, they're covering.
I had a case last month where the tenant, there's like a stop on the door and they pushed it so hard it ripped the door off the hinge. So I had to call a repair guy to fix it. It cost me like $150.
Yeah.
In my contract, it said anything over 300 or 200, they're liable. I paid for it myself, but I could have legally had them pay for it, correct?
I would have told you not to do that because that would be normal wear and tear in my worldview. One of the things that landlords get wrong all the time is carpet.
I'm just gonna ask about carpet, what's the carpet?
So the problem that we face is all of the judges have, literally, all of them with one exception, in Colorado have been elected, appointed by a Democrat governor.
Okay,
They're all very pro-tenant,
okay.
with one exception. And as a result, we've had fairly pro-landlord laws, but they're getting interpreted pro-tenant. And when you're the judge in an eviction court, and all you do, your entire docket is just carpet complaints to the judge, whose sole job is to find out the facts of this case and enter a judgment, right? So the facts of the case are, is this normal? I see it every day, all day long. Carpet stinks, tenants did, that's normal.
What about bleaching the carpet?
So, you know, that's a big one that comes up a lot. So if it's, a lot of lawyers will say that if it's a single transaction or occurrence that happened to the carpet, like they drug an engine across the carpet and ripped it, that triggers abnormal wear and tear. The problem is the judge is the one making the decision, and for them, it's another carpet case. The carpet's been
Take care of
totaled.
us.
It's always totaled. They're just not gonna give it to you. I've had cases where we cut out the carpet because it reeked. We put it in a evidence bag, put it in the refrigerator, held it until evidence day, had the judge sniff it, and the judge was disgusted and said, nope, normal wear and tear.
What?
Yeah, I would, anything on the walls or carpet, I would not ever touch it.
And
What
it's-
about if someone smokes in your house and it's a non-smoking
Ooh, that's a good one.
home and you go in there and it just reeks of smoke, cigarettes?
Yeah, so how do you prove that?
That's,
Smells like cigarettes?
Okay, so you're filing for court, how long until court? Now you've got a chain of custody problem. So let's say you take,
And you're
and
not
I had a
gonna-
case like this a few years ago. This was my big reveal moment. This was a fun one. We took the curtains in, smelled like smoke. We tried to hit them with the penalty for the full amount of their security deposit, and we won this one. The tenant, the judge was not going to let us have it at all, and the tenant took to the stand and said, "I don't smoke." And I sat there and I grilled them and grilled them and grilled them on the stand. And I said, "Your Honor, can we take a 15-minute break? I need to go." I
and
need
he
to go hit
smoked
the restroom."
outside.
The judge and the tenant went outside and smoked a cigarette together.
Come on.
And when they came back up, the judge was like, "I'm sorry, I have to raise this issue. I was outside at the break. I witnessed you smoking
You perjured.
You
But if
perjured
you
yourself.
didn't see him
I find
smoke,
you
you
not.
would have given it to the tenant.
for sure."
What a joke this
For
system
sure.
is.
So the part of the problem is the practical side of this, right? We can read what the laws say, but then bringing it up in front of court and proving it, it's a whole different game. So I tell landlords, if it's carpet, it's normal wear and tear.
Okay.
Carpet is personal property in many ways, and you kind of need to treat it that way.
What about the door hinge situation? You would have told me to have the tenant pay for it,
No, I would have said that's normal wear and tear.
even if there's a stop, you
Get
can
it.
clearly see they extended the opening and ripped it off the hinge
What if
because
it
of
was a
it.
5-year-old that just slammed the door?
They're still responsible because they're in
It's
charge.
normal
The
wear and tear.
5-year-old's not the one.
What if it was a service animal? A dog,
But
a
they're
Great
watching.
Dane?
It's their responsibility to watch the animal
What I'm
and the
saying is
5-year-old.
all that chaos that can happen in that house is normal. I had a case last week that came up and it was a Great Dane service animal. And the owner wanted to do the carpet thing because there was urine in the stains. You can't penalize somebody for having an appendage, and you can't penalize somebody for having a service animal. The service animal is deemed an appendage.
So in my hinge case, you would have told me I pay for it and just shut
I
up.
would've.
and let
Yeah,
it
I
go.
would.
I would've.
The
Now,
I
risk
did
to-
do that. I didn't want to
I mean,
fight
the
for
risk to you and
$150,
them
but
coming after you
And here's the reason I would have told you it's your bill, because you didn't specifically itemize how you got to that cost. So I would rewrite your contract. When we say reasonable amount, in my leases it says I'm $4.50 an hour, and my cleaning people can get $2.50 an hour. I know they don't actually get charged that, but I have it in contract that we've already agreed that these are reasonable. And here are the number values assigned in the contract.
Like I like if you put anything in the disposal, this is the fee for a
Right.
new disposal.
And if I go,
Or
you know,
if you-
as landlord, if I'm gonna go testify in court, that's gonna ruin my whole day. I'm getting paid because my witness charges as a witness to the condition prior are in the contract. I'm $4.50 an hour.
This is why they say live in a blue state but invest in a red state.
Or tighten up your contract.
Yeah, well,
The reality
laws
is,
can be
So we
interpreted
can-
by the judge, so what really difference does it make?
yeah, so in this
this is
situation,
right.
what you left yourself exposed to is reasonable and normal wear and tear. So get rid of the reasonable and say contractually definite. So they've already agreed to what those costs are gonna be. If you leave it open-ended, then you're limited to reasonable recovery.
And what is that? Yeah.
And you'll always lose that argument. 'cause
What
it
about
just-
math?
Where are your leases?
I need to.
What about if
This is-
somebody does math in your short-term rental or
That raises a great different question. One of the best reasons for having a property manager is their insurance. Because that's an omission or an error no matter what. The property
What was your
manager,
question, Karen? I didn't hear it.
what if they do meth in the home? The problem is that's a criminal activity. Whose responsibility was it to prevent the criminal? It's not yours as the landlord, but if you hire somebody to manage that property and they omit to check on it every 5 minutes, I know that's an unreasonable standard, it's still an omission.
So you have to learn.
And if they didn't disclose to you up front that that is an impossibility, that's an omission. So on an errors and omissions basis, you get the property manager every time when you have a catastrophic loss like that. So yes, they charge you 5 to 15% of your lease income, but it's worth it because when there's that catastrophic problem, it's almost always their fault.
So landlords now are asking to be put on the insurance of the landlord for that purpose. To try to slide the liability off of them, or to share the liability.
So
Property managers are?
Yeah,
I've had one asked to be on their insurance.
they asked me to be added as an additional
As
insured on the
additional
insurance of
insured
the
on
house.
Insurance.
I could see that. I would say the primary reason is actually the additional insured, independent of the owner or the tenant, can file the claim. And so I always recommend that you get your tenant to have not tenant insurance, but liability insurance, and then add the landlord as an additional insured. Because when the tenant disappears and floods your home, or disappears because they got jailed for doing meth, now you can go and file on their social security number and on their insurance rating to have the insurance cover whatever happened in the house when they were gone,
Not just the landlord.
not yours.
And then for short-term rentals, I mean, you have if you're doing it through Airbnb or whatever, you can go through their insurance as well.
Yeah.
And they actually told me on my short-term rental to actually do the same thing. If you do this, the fine is this. If you do this, the
Right.
fine is this. And
Enumerate.
then they will support me with their attorneys to go after
Right.
the,
If you
Yes.
specifically itemize what the costs are gonna be for exactly what's
For like a
happened.
plugged toilet, you can do a cost for that
Absolutely.
and have them pay for it?
So the way I handle it is it's my hourly. I put my hourly in there. If they want to object to my reasonableness, let's say I went out and I got a plumber and he did it for $60, my actual cost. And by the way, the new law says you have to charge actual cost. Well, if I do it myself, it's $4.50. That's my actual cost and it's written in there. $4.50 an hour. If I have the plumber doing it for $120 an hour
You have to
and they
charge
object, fine, I'll take my rate. You
it's one or
see?
the other.
And they're gonna be like, okay, I'll take the plumber's less, I'll take it. But you wanna itemize it as best as you can.
You
And
can't itemize every problem though, that's the issue.
you
It's
kind of find the
very
known
difficult.
ones though that are,
Yeah,
they do,
common.
they're, like I can show you some of my property managers leases and they have a whole bunch.
like
of
painting
things
is gonna be
in
so
it.
much per hour plus cost of material. Plumbers are gonna be so much per hour, cleaning people are gonna be so much per hour.
And that's after they leave that they're required to pay? Or?
Yeah,
there's
if you're
a
gonna
couple-
deduct something from their security deposit, you have to specifically itemize it
That's good, that was one of my questions.
in detail And if you didn't sufficiently itemize it, you're up for treble damages. So the more detail, the better.
And how long do you have to disclose to them, let's say the carpet is messed up and you wanna take it from their deposit? And is there a time frame?
30 days unless the contract says 60, and then up to 60. You have to do the final
Not doing
accounting.
the carpet, you're gonna get yourself in trouble.
I would
Carpet,
lose, of
carpet.
course. This is-
Carpet is just a terrible idea. Just-
Yeah,
Just don't put carpet in your property.
just
Yeah.
change the carpet every time for free.
And there's a
Put an
lot of really
LPV.
bold landlords that are trying to do the carpet and trying to go for really large damages. Let's say, today I had a call. They've been there a year, the lease auto renewed last month, dad guaranteed the lease. He told them that after June 30th, he wasn't gonna be guarantor anymore. Paid a $4,000 penalty to get out of being guarantor. They received the money, kept the money, applied the money towards rent. The daughter has not continued to pay rent, and now they're trying to go after the dad for the remaining balance all the way until June 30th of next year.
You can't.
That was today's little,
The renters are?
the
kids?
landlord is going after
Oh,
the,
the landlord.
the dad.
Even though he took himself off.
Well, but did he? There was a, release that they sent saying you have to sign this. He signed it, but the daughter didn't.
Mm.
Oh, jeez.
Well, is that required? The problem I have is they kept the money. On what basis did they keep it? Is it theft? Is it embezzlement? Is it commingling? Which crime do you wanna go to jail for, or do you wanna release my client?
Oh, jeez. Wow.
Right,
Yeah.
so the language starts to change when you get into this type of
Huh.
situation. But,
Jeez, that's so sad.
yeah, so we start to get into these after contract breach negotiations and things get crazy quickly.
But do you have like a pretty template lease?
I was
that
gonna
would-
say, is that something
I
that we
review
have to
leases
start
all the
with
time,
and-
so
Okay.
people have their custom leases and I will review those and go over.
And how often do you recommend that people get a new lease, a new attorney, or at least, is it annually you gotta have obviously your lease is
I
usually
never would have
year,
said
but-
annually prior to last year.
Yeah.
Last year had so many changes and they were so massive. The landlord that was trying to take this new client to task, they made some pretty fatal mistakes because they didn't update on last year's terms,
Mhm.
and those are all criminal. So now I get to say, when a contract creates criminal liability, you cannot, it's not possible, it's not legal to have a contract for a crime. We can't have a contract to go buy cocaine. It's not enforceable. It's a crime. And this person has a contract with this professional property management company. They didn't update their lease. Their lease creates a crime. And now it's a contract for a crime. It's void. The whole lease is void.
Wow.
Because it's out of date.
Because it's a crime. There's last year's updates added criminal liability, landlord liability for having certain language in there. So, for example, if you have 3 months of security deposit, you're done. You're not allowed to have more than 2 months.
So you're saying it's a crime of omission that they didn't have a
It's-
lease that
It's not a
was
crime of
updated.
omission. In the statute itself, it says that if you have this type of language, it's deemed a crime. It's
In your
predatory.
lease, You gotta take it
It's-
and do the.
Okay.
It's a crime to,
It's because of the
They didn't
statute
change
that
it.
literally says this, if you
It's the
violate this
max.
rule, it's a crime.
Hmm.
And
So
they
to
didn't update.
keep up to date on, landlord laws as they come out, it seems like, so legislation happens and then they come, typically it's
In July, it becomes active.
July-ish, yeah, that it comes out. There's a website I went to that's pretty good, you can actually go out and drill in, so if people give me their emails, I can send you that, there's some like group that dummies it down a bit. And
Right.
puts a high level of what the new bills
I would say
are.
when you're doing that research, just make sure you're Colorado specific, because a lot of people say, what are landlord tenant law
Right.
updates?
Yeah.
And then they'll get California law, and it's not at all applicable.
Yeah,
So make sure you're
well, I'll pass
specific.
by the website I use to look at
The management
Programs.
company that we have currently, on 2 of our properties sends us all the updates too, so that's a benefit of. But we were considering stopping the management company and just doing it, like me being the property manager, but
Yep.
if I'm listening to all of this, it makes sense to pay them
Mm-hmm.
Yeah, especially just for
100%
your-
hands
Yeah.
down legally.
Yeah, I completely stand behind that.
Okay.
Now,
Could you review their leases, or you would just assume that their leases are being reviewed by
You
a?
need to make sure they're reviewed, by they're having their attorney write the lease and review them.
Because I mean, I know the property managing company has charged us for like plumbing issues and this and that.
Yeah.
So, but that should be written at least that the tenant pays that.
Well, no, if it's
No.
normal, yeah,
Wear and
you should
tear.
be paying.
Okay.
Yeah, you're gonna have, if the house is just, your plumbing will just go bad eventually. It's nothing that the
Absolutely,
tenants
but
can
if
do,
they're plugging the
right?
toilet every 6 days or every week.
Yeah, but it,
so the way that I write mine is I have
Yeah.
a triple net lease with my tenants. And I say, you pay this, you pay all the maintenance, it's your property from here on out. I delivered it to you in good working operating order. And as long as you wanna stay there, you gotta fix that. Some of the new laws are saying
Okay,
that you have to maintain good functioning, this, that, and the other.
yeah,
It's okay to have them responsible for the maintenance as long as you watch that timeline. If, like on the septic elevator example with the toilet,
yeah.
if the tenant takes longer than 10 days to get that repaired, you better
Oh.
take care of it and get it
yeah,
fixed.
Okay.
that's really,
Most-
how do you know that they're, if you put it all in them, that they're just not doing it?
That they're just gonna
Right,
do it.
there's a big issue
That's
there,
gonna
and
cost you way more.
I mean, what I
property
did,
managers have to supervise that, and that's again where property
property
managers
managers.
become valuable, because if they failed to supervise it, then whatever damages you can get from the insurance.
Yeah, I wouldn't play that risky because of,
Exactly.
unless you got some, you know your tenants well.
So I have it on black and white in that regard, but then when they call me, I handle it,
Okay.
Yeah, okay,
right? So
so it's just a
I
backup.
play a different game where on paper, if I take this to court, I can push those expenses off on them and say,
Mhm.
you agreed, but then like a broken refrigerator, I'll take
Of
care
course.
of, right?
Dishwasher, I mean, it happens.
Right, so in Texas, it's normal to have triple net leases. In Colorado, it's normal to have the landlord cover all the major functions. And that's a cultural thing, and it's seen as very abnormal to have a triple net residential lease in Colorado. But profit is not illegal yet in Colorado. So you can still have a contract that preserves your right to profit. And if you get to a court scenario, if it's in the contract, the judges can find.
Yeah, cause you don't technically like have to repair the dishwasher in Colorado law right now, right?
Correct.
Yeah.
Hmm.
It's-
Well, they say all major appliances,
So
so,
the major appliances, heat, what is it, it's like, you have to provide heat, major appliances, and then.
and it's
water,
municipality
structural.
specific too. Like in Boulder, they require that you have high quality lighting.
Yeah.
But here's the
Who
thing, my
determines
advice, if you piss off the tenant, the costs in the long run are gonna be
Be
way
way better,
worse,
yeah,
right?
100%.
So it's
I
like,
mean,
you
what I
gotta
did
have
was
that
It's
after
funny,
balance.
cause here you have to be scared of your tenant.
Well,
You
I mean,
do-
I think you always have to be scared of your tenant,
Yeah.
cause they can do a lot more damage to your house than,
Correct.
so you kinda always do.
In certain states though, you can call the sheriff and they show up the next day and kick them out.
Hmm,
Very rarely here.
yeah,
There are circumstances like that, but very, very rare. I would say your biggest risk as new investors is your own emotional draw when you have a tenant that is, squealing. Like, I was in the hospital and I couldn't make rent. You feel the emotional draw to give them an extra week. My recommendation is you set hard deadlines, right? Rent isn't late in Colorado until the 7th, so you've got that mandatory grace period. That's new, like, it used to be the 3rd, right? You could
Yeah.
apply late fees on the, now it's on the 7th. I typically have an extra 7 days. So on the 14th, I start getting aggressive. So we're in soft conversation where I'm being kind and more gentle for that 7-day period, saying, so what's the plan? When are you gonna pay? Let's put together a payment plan. But if they pass the 14th without communicating to me in some way that I have the assurance that they're gonna fulfill, then you need to, in my opinion, start the eviction get it going, and the reason for it is, if you can get the tenant on a post-eviction agreement, those are enforceable immediately upon default. So the option here would be continue for another week with illusory promises, which are, you know, when the tenant says, oh, I promise I'll have a job next week and I'll pay you. Oh, I promise my mother-in-law is sending me money, I'll get it to you. Those are potentially illusory. They've already breached their first promise, which was to pay rent on time. And now they're making a secondary one, and you're just gonna say, yeah, okay, and then a third one, yeah, okay. You're not getting any teeth. So stop negotiating, right? From the 7th to the 14th, engage in that good faith conversation with them, treat them with dignity. After the 14th, no. Get it court supervised, right? The value of that eviction is that now on your say-so, if they violate that post-eviction agreement, they're gone. None of the timelines apply anymore. So many of the recent law updates have been on the timeline required for evictions. They can take 45 days, they can take 180 days. And in some very extreme cases, they'll take a full year, depending on which laws the tenant is taking advantage of. So if you get to that 14th and you start the eviction and everything goes well, 1 week later and they've signed the post-eviction agreement, now by the operation of those agreements and statute, as early as 2 days after the breach, you have the writ of restitution in hand and you can go to the sheriff and
But
ask.
that's if they sign that agreement.
Yeah, but so you make it
through the court.
you make it practically impossible for them not to sign it.
How do you,
So you're in default and I'm ready to evict you. Let's say I want you out of the house, no matter what. I will pay you $500 to leave by next weekend, and I'll dismiss the eviction. And that's our settlement agreement. Sign here. If you're
that's
not,
the post agree, the post.
it's a post, so you started the eviction, and now we're doing this agreement. So you have until Sunday, 5 p.m. to be out. At 6 p.m. on Sunday, if I show up at that property, I'm putting in a motion to the court saying you violated the agreement. It's a court supervised agreement. Judgment's gonna enter as soon as the judge reads the violation. And by statute, we have to have 2 days, unless it's a squatter eviction. By statute, you have to wait 2 days until the writ is issued.
And if you offered me $500 and all this stuff, and I said I don't want to sign that agreement,
Then I would continue with the eviction.
which could last a year, 180 days.
Yeah, but here's the thing, you just entered the case because you showed up, so now I've got personal jurisdiction on you and now money damages are gonna attach. So if you showed up, you've made yourself extremely vulnerable, and I'm gonna release you from that vulnerability by letting you sign away additional rights. And when you sign it, you're gonna perform, or else. And now let's say I want you to stay there, let's say you're gonna stay for another 5 years. Okay, then the terms of the agreement are, you're going to pay on time every time and never violate another term of this lease. Is that fair? I'll even give you a payment plan. We'll reduce this month by $500, but we're gonna give you an extra month to get caught up, and then it's gonna be normal. Good? And if it's normal, we drop the case. If you fulfill the lease, then there's no eviction on your record. Sounds like a great deal, right? So you'd sign off, and now you've got this tenant on there for the rest of the term. It's court supervised, and the second they violate the lease, they're gone. So the value of that eviction isn't that you're actually wanting to throw them out. The value of the eviction is that you get this supreme court supervised lease. So that's a way of hedging your risk. The biggest risk on evictions is that the tenant knows how to manipulate the system and cause lost rent for an extended period of time. And typically that's 45 days to
And damage to the
Correct.
property.
and damage to the property. So like, I don't ever talk about security deposits with my tenants on their way out, because if you say, I'm taking your deposit because you didn't pay rent, your house is ruined. They have an emotional attachment to the hope that they'll get their security deposit back.
Yes.
So I never have any conversation about that at all as a matter of procedure. I can't say yes or no. My clients are required by law to do that accounting after you have successfully left. So I will guarantee you they're gonna do that normal procedure after you've left. Right. So, structures. LLCs, in my opinion, are one of the most challenging entities to use for holding real estate. There's a lot of reasons for it. So a lot of the major investors are using LLCs to try to firewall how they hold their assets. But for young, new investors, I don't recommend it. As soon as you get an LLC for the holding of your assets become commercial. So you're gonna get commercial insurance, typically. There are some very few exceptions, but most people get hit with commercial insurance. Corporations cannot self-represent in court. You must always have an attorney. So every time you have any kind of an issue, an attorney's got to be involved. So there's no small claims court allowed. You lose the whole court. The other thing that the LLCs do is most of them are done wrong. I would say out of every 100 I review, I might find one that's been done right. And that's by attorneys. So the very expensive, fancy binders with the full-blown everything, I have yet to find one that's been done correctly, because Colorado has very specific rules about the stock certificates. You open it up, you look at the stock certificate. If certain things are missing from that stock certificate, then the proof of ownership is gone. There's no proof. When you do an LLC, you're required to file in your articles of incorporation who is the registered agent. The registered agent only is the person who gets service of process in the event that you're being sued. It doesn't say anything about ownership. So the risk that you run is you have nothing on public, and this is one of the advantages of LLCs, is that they're anonymous, right? The landlords don't want to be known to the public who is in charge. Anonymity has a problem. I have a problem with the security of an LLC above everything else. All other considerations, the LLCs are done wrong, they're not evidenced right, and when they are evidenced right, they still don't provide you with the liability protections that they claim to in Colorado. Colorado's judges and laws don't really protect you for a lot of the reasons that we had up on the board before. When you've got commingling, you're done. If you're using it as an alter ego, you're done. So like if you do that, the S-Election LLC, you're already admitting that it's an alter ego, unless you keep all of the formalities of a C corporation. But that's the whole reason that you're choosing an S-Election, is to get away from the formalities of a C corporation. So there's the misnomer that the LLCs are providing you with legal protection. I don't like them. As you know, I do trusts. Trusts don't require registration. There are no formal annual compliance obligations. There's no such thing as commingling when you're the grantor, the trustee, and the beneficiary, which is what most initial estate plans are set up as. You can't violate a fiduciary to yourself. So you can handle those assets in a way that benefits you without creating a piercing of your trust entity. They're still private, but when you record it with proof of ownership and who has the authorities on behalf of the real estate. So in that regard, you're not negligent.
I would assume that if you have an LLC owned by a trust, you still have the same problem, because it's an LLC.
On the criminal aspect, right? So I still like a LLC owned by a trust, but for operations, not for holding. So when I started off, I said for holding assets, LLCs, in my opinion, are bad. Don't do it. For operations, they're wonderful for firewalling you from personal liability, unless you're a licensee. If you hold a professional license, you can never get rid of that liability, never. So don't bother.
So when you say it that way, that means like your actual property sits in a trust and you have the LLC if you were the property manager, but if you have property managers taking care of it, then just the trust is all you need to protect you.
for
that
a
I just
different, yeah, you're totally correct, but for a
Okay.
different reason, and this is jumping into the tax saving side, I recommend that you have an S election LLC for your active management of those properties. So hire it out so that you have the insurance,
Okay,
but still pay yourself a salary for managing the manager.
okay.
Okay, so here's how that works. The
That's
trusts,
my next question.
trusts are at the second,
For this.
Okay.
trusts are at the second highest tax bracket. They're at 21%-ish.
Okay,
Okay, generally speaking. So now we gotta buy down the effective tax rate.
Yep.
So let's say we've got $100,000 in rental income that we want, that's in that higher tax bracket, we wanna buy that down.
Okay.
I've got an S election LLC, which by the way, they now default to S election. So when you create them with the irs.gov, they're automatically S election unless you choose otherwise.
okay,
That switched 2 or 3 years ago.
okay,
So pay attention to that when you're filling out the paperwork, just to make sure that that's still the case.
okay,
But the way that I do the trust is the trust files on a separate tax return. The way that I do them, I give so the IRS code says you, with a intentionally defective irrevocable trust, they may be filed separately. I like them filed separately because I like to firewall my CPAs. My CPAs need to have a simple task and complete it for that entity, and then have another CPA complete it for that entity, and they shouldn't necessarily talk about it with each other, because CPAs get into this difficult position of saying, how do I feel about this treatment? And if they get the full overview of your entire enterprise, they might say, I feel uncomfortable about this aspect. I don't want to sign off on it. Having them sign off on an LLC, on the trust, on your personal tax return, separate, a different one for each one, is gonna make them feel a lot more comfortable. They're in, they're out, they've got limited exposure, and there's all kinds of plugins that you can do in a trust structure to buy down your rate.
okay,
But the different CPAs aren't necessarily gonna wanna know about all of it.
okay,
So you set up the trust on its own tax ID. It owns a S election, which means those taxes can actually flow up to the trust's EIN number. And you're an active manager of that personally.
okay,
So you're gonna pay yourself a salary. The trust is gonna pay the LLC for the management of the rental income, let's say $100,000, because that's what we're trying to get rid of.
okay,
The LLC is gonna pay you an investment into your 401k or your other retirement income, which now becomes a deduction to the LLC. And depending on how much you're allowed to put into the retirement account, you can drop your taxable rate to 0 on that S election LLC.
see, this is the stuff that,
So now you're deducting your investment, your retirement investment,
okay,
while also not having any of the liability from the operations, because you have a professional manager who will make the omission when that happens. And it happens. It's in my experience, it's about 5% of tenants that are terrible.
yeah, I've already had one.
So if you've had one, rest assured, if you get your procedures in place, there's going to be a lot of really great ones. I've got tenants that have been in there 17 years, no problems. Long, long time.
Okay,
So I mean, probably because I'm a CPA, take ethics classes, wondering why you want separate CPAs.
It's the way that I break it down is your ability to oversee everything as a CPA gets challenging. When you go to a tax planner, they'll give you all kinds of new tax shelters that you can use. And so, for example, your charitable giving, you can use that. You can deduct up to 60% of your income by giving it away. Quite literally, the IRS code says effectively, what you don't give to your local charity, you're entrusting the IRS to spend better with. Why would you not give it away to your local charity? And you can earmark at your local charity how you want the money spent. And there's a lot of gray area there. You're not allowed to exercise control over it. You're not allowed to receive the direct benefit. Okay, well, let's break that down. Who are you? It's your social. If your social made the donation and it's your social that's trying to buy down your taxable income, then your social can't receive that benefit. Well, implied in that statement is any other tax identification number can. So you start talking about dominion and influence versus control. And that's what that earmarking works as. So foundations are basically publicly announced, self-controlled charities with a requirement that 5% has to go to a separate charity on top of that. There's all of these things that you can add in. So I've got a family tax strategy with estate planning for real estate holdings that you can use that have these plugins that you can use, like the cost segregation model. The Family Management Corporation was the LLC that we just talked about. You can do income splitting among the family. All of these family tax strategies you can use, but it's the tolerance of your CPA that I worry about. If you give your family affairs to one CPA, they'll handle that no problem. When you then go to a CPA who just handled your family affairs with an irrevocable trust, most of the time they don't know how to handle it. So you're getting into a competency problem. Whereas if you search out a CPA who's good with trusts, they'll handle it no problem, right? Now, if you were to go to that same family CPA and you say, look, I've made a charitable contribution to a foundation which made a charitable contribution to another charity, and I exercise dominion, nope, they don't want that. They're gonna say, I'm done, I don't agree with that. Well, go to a CPA who's familiar with charities.
So just going to whoever's the specialist.
Yeah, but even if you had somebody who was a super specialist, I would advise the CPA to not take a full stack and try to claim that they know all of these areas.
I mean, similar to like your situation, right? Your guy's really good for your own business, but didn't know some of the real estate stuff.
Right,
Yeah,
most of
it's
CPAs don't know anything about cost segregation. I mean, to be honest, I've been to a
They're
lot
not
of.
tax planners, they're CPAs, so they don't look out for your best interest in saving tax.
Right, and tax filers are not tax planners, and CPAs are not. I mean, you really need to pick out the exact profession that you're looking for.
Well,
Like,
the same
this
thing
stuff
with
gets
attorneys,
expensive, though,
like
'cause-
there's a lot of attorneys that cannot help you with your real estate
Right.
leases and that kind of
Right,
stuff.
and I don't file, I don't crunch numbers. I give the master plan, and I can tell you about all the plugins that you can use to buy down your effective tax rate. And they're different. Attorneys look at my stuff and they're like, wow, did never consider that. A lot of attorneys recommend never doing an irrevocable because of, they claim you're not allowed to make any changes. All of the case law says different.
In your situation, do you think it would be beneficial for someone to do a revocable trust just for
No, never.
tax? Why?
No, never. So let's say you've got a revocable trust and you get outside and you cause an accident, you run over a pedestrian. You now have an unintentional creditor and they're gunning for you for everything you're worth. And I'm a personal injury attorney, I actually am. And when clients come to me, the first thing I do is I put them on a contingency. So I'll take 35% of whatever I collect. And that's how I do my deal. Now, as soon as the client is outside of my office, I'm looking up how much you're worth.
Yeah, but if you die, everything goes to probate. If you don't have a trust that everything has,
Yeah,
it's
but
more for your heirs is the reason why someone would do it.
so when you're doing estate planning and you're talking about after death benefits, that is a very tiny slice of what estate planning can do. If you open it up into lifetime planning, you get all kinds of great benefits. You can create infinite banking, so you have private banking and dividends that pay into larger payout returns that grows your principal, over time forever. Colorado's the best state, in my opinion, for having what's called a dynasty trust. So you can style your trust to be a dynasty, which means no transfers are required to take place for up to 1,000 years, which is awesome for tax reason, because the tax people only hit you when there's been a transaction, right? A taxable transaction is what triggers tax. If you're not required to have a transaction for 1,000 years, those are compounding benefits to your family. So the super rich will borrow against their assets, use that debt as their disposable I'm gonna say income, but it's their disposable proceeds for buying, cars or vacations or businesses or whatever. But then they've never realized any income because they borrowed against
Right.
the growth.
So are you saying in that personal injury case, if it's revocable, you could go after it, if it's irrevocable, you cannot?
Correct.
Okay.
So the
Remind me
only
the difference between the two again.
Yeah,
what
the-
you said.
the
I
only
didn't hear last
distinction
month.
between revocable and irrevocable is
What you can take back out.
creditor proofing and the potential to file on a separate tax return.
The potential, you don't have to.
You don't have to. I always recommend that you do.
Okay,
The reason that I recommend that you do is because of the follow-up question. How am I gonna find out what your assets are? Let's say you did it, let's say your estate planner was really smart and you did not put your last name in as the name of your trust. It's something totally innocuous. The coffee cup trust. Okay, I can't find that, I can't search for it.
You're scaring me because I started an irrevocable trust 2 days ago.
Irrevocable?
I'm sorry, revocable.
Okay, so
but it's not in my
we'll
name.
change it. So if it has your last name in it, then I can find it, no problem. If it doesn't, then you've taken one step further, but here's how I'm gonna get you. Can I see the last 2 years of your tax return? You're done. You're done. Anything that's in that revocable trust, now when we get to court, I'm gonna say, Your Honor, in his personal name, he retained control over these assets in a revocable trust. One of the enumerated powers is that you retain personal control. Your Honor, I'd like you to order my opponent to exercise that control, to revoke the assets, to pay my client.
Even if the business, the real estates are in separate LLCs in the trust.
Yeah, doesn't matter.
They're in LLCs though, and you're telling me that that doesn't give you any protection.
No.
So this is the thing, everyone says something different.
different.
No.
I know.
Can you
The-
attorneys all just get
No,
along?
here's the problem.
Tell us one thing, please.
With the revocable trusts, you've retained those powers, and the judge, here's the double speak. Do revocable trusts protect your assets? Yes. The problem is that we can circumvent your trust. When I ask the judge to tell you in your individual capacity to exercise your authority to revoke the assets, I did not pierce your trust. I used you to violate your own trust. That's the distinction. So
Totally
your
understand
attorneys
that.
will tell you, no court will pierce this trust. That's a true statement. Every court will order you to do it to yourself.